Well, the state of freight is always a favorite feature of our events because it's our most attended webinar. It's also the one thing that I think people consistently want to know is what's happening with freight.
Right.
So we're going to try to answer those questions. We'll try.
Try.
We're going to avoid big predictions today.
Why not? I don't know. Maybe
You want to make some big predictions?
maybe like
You want to ask me? You
calls?
want to put me on the spot?
Yeah.
All right, we'll do that as long as we don't play the tape back. So
Get tweeted back. Well, let's, Craig, you started off the day talking to Leland Miller, who I thought was perfect for setting the table.
for sure, for geopolitical, I don't think there's a better resource than Leland.
Right. And I mean, I think
And one thing I like about Leland is he takes original thoughts.
Yeah.
Versus a lot of times you get these media folks that sort of regurgitate other people's
Yeah.
stuff, but Leland is a source of truth.
Yeah, he seems to have a very clean, objective point of view. You
Yep.
kind of can avoid the politics of the situation.
Which is
to an
weird. He's
extent.
working with the administration.
I know,
avoiding
right?
Politics at the same time, but yes.
But I think that's kind of like the way that I want to start this off. If we go ahead and pull up the first chart that I want to set the table with, because obviously I talked to a lot of people across the industry, across multiple sectors in the shipping community, and everyone kind of says the same thing. You hit on it earlier today about like the uncertainty of the trade policy, economic situation, and things like that. And I feel like that's reflected the best. I even alluded to this in the SONAR demo this morning in the IOTI. And to me, this is like the chart that explains 2025 freight market the best. What do you think?
Well, I think certainly in the ocean market.
Yeah.
I mean, it is the ocean market.
Right.
International container bookings. And I always say this, I have a 6-year-old, we like to play puzzles. And I've said this before, but I'll say it again. If you take the April lull is that dip that we see in May, it really started in April, but actually it was May, is Liberation Day tariffs. And you see that rebound, but that mountain, sort of cut that out and you put it into it, it would basically be flat.
Right.
It's like what effectively drove those high import numbers and record high import numbers back in June was the sort of resurgence of all that volume of freight that had been left behind, if you will. And I actually think what's happening right now, the big dip you see right now, I think we should ignore it. It is a seasonal Golden Week. It happens every year. But what we saw right before Golden Week was what I call stabilization.
Right.
Like it's a pretty boring chart, frankly, and arguably the most stable in the years that you got pulled up, except for the holidays. It's arguably the most stable line.
Right now, like the past month and a half, yeah, I think it was an early seasonality. And I think this is, the point of this chart is really like we kind of broke seasonality for the first part of the year with that dip in May. And now we're left wondering what happens next.
I think Leland's comment this morning, for those that heard it, was probably really interesting. Was he pointed out that the tariffs are not overly punitive to China.
Right.
Like they're in this weird, call it almost perfect scenario for both parties.
Right.
Is they're Goldilocks, if you will, where they're punitive enough but not painful to China, and they're punitive enough but not painful to America that we can live in this sort of stasis.
Right.
And I think that's at least what the international container import data is saying, is like, no one loves the current tariff situation, but it's better than no one side is winning. And I think what he had argued was that it's probably what we're going to see is no real change to the way the policy is going to work going forward. The 100%, and I talked to him both last night and backstage, and he's like, I don't know that is realistic or ever is realistic, nor do I think we'll see the Chinese sort of cave on things.
Yeah, I mean, I think it's a fascinating take on the fact that some of this is economics, some of this is international relations and geopolitical stuff trying to keep us.
It's like geopolitical competition. It's a Cold War of sorts, I think, as he would describe it, and I think that's what we're seeing.
And how it's manifesting in freight from a demand perspective, and this is clearly like this is like the earliest signal that we get in demand is this bookings data, and it's container freight, mind you, from that stuff that goes on the ocean. And to me, though, Craig, like it's not worst case scenario, because even as we're going through this Golden Week seasonality loop,
it's started to rebound. It's above the 2023 numbers.
I think 24 and 23, honestly, were a little bit overheated.
And by the way, the forecast is that dotted line They're starting to resume back to where we were last year. So it is telling us that like trade is stable. And I think that's, if I took anything from this, and I don't know if you added the dashboard, the trade war dashboard, we could actually see how
I didn't to this one because I couldn't fit it into my
okay, so there's if you looked at the trade war dashboard, you would see that China has taken the brunt. India actually took far greater brunts, but China has taken a lot of the volume, has come out of the market. This is all countries. Vietnam and Thailand to pick the slack. A lot of that's transshipping. But both of those countries are benefiting in terms of volumes. And they're not seeing any level of pressure despite China's slowdown.
And so my read on this chart, especially using the SAMA there, is that we really don't see any demand shocks moving forward.
There's nothing there. And there's no sign that this 100% RET is actually
going to meaningfully
is impacted at all. I think financial markets had a sort of short-term shock, if you saw that 2 weeks ago. Stock market had, I think, one of the largest sells off in terms of speed. It was all in like a 15-minute window where we lost, hundreds of points in the Dow. But I think a lot of that was short-term. We recovered on Monday, and market's a little fluid right now.
So demand side stuff, forecast looks fairly stable, consistent. I think also another somewhat positive takeaway is we're not seeing any kind of recessive.
There's nothing there in this chart that shows that international imports. One of the interesting things I'd love to talk about it, Zach, that I think is, you have pointed this out, is the freight that is local versus long haul. And I think this is one of the most interesting stories in freight right now, is this chart as we look at it. And so just to be clear, that orange line is the long haul market. And that white line is the local market. The reason that this is important is the local market is highly, and that's that city outbound tender volume, that white shaded area, that is highly correlated to distribution and retail. And the reason being that it's so highly correlated is local within a 100-mile distance tends to be distribution center heavy. Manufacturers, U.S. manufacturing, with the exception of maybe CPG type stuff, like bottled water, just plants all over the country, local bottlers. But for the most part, when you get into that city distribution, that is typically retail goods being distributed locally. And what I think is really interesting about this chart, and one of the things when we talk about the collapse in the goods economy, I get a lot of sort of haters on X that were like, wait, retail sales are doing okay. E-commerce sales are at record highs. How can you possibly see that the goods economy is bad? And you pointed out, I think you actually saw this chart first, because we paint 4 million charts a day. So it's hard, but you've discovered this, is that in the local distribution, that city distribution, is that we're actually up 2% year over year. Is that right? It's hard to read right here. And the long haul stuff is down 30%. And that long haul stuff is, a lot of it is manufactured goods. It's manufactured goods that are
finished,
that are moving through the economy. And that tends to be a large piece of the over-the-road truckload market, tends to be manufactured. And that is what the pain. If you're in local distribution, you're okay. If you're in retail, you're doing okay. The consumer has not slowed down its spending in sort of big box retail and e-commerce. But there is an absolute utter collapse in the manufacturing goods economy, which I find ironic that Trump's policies were intended to drive a manufacturing renaissance. And what the data tells us is the exact opposite is happening.
It's I mean, and also the long haul sector is very fungible with intermodal and rail.
It definitely is. And so the other thing to keep in mind is a lot of the volume, let's pull up the rail intermodal chart. What we're seeing with rail is that rail has taken up so much of the volume, and this is a delta between the rail data in terms and the truckload data, right? So it's comparing the two markets. Rail is actually up in volume, right? I can't see.
This one's actually showing
down. It's -6.
It's just started to show a negative.
Tiny.
It's
for us. You can't see our confidence partners, but they're real smart. I'll have to look back.
So OTVI in yellow, down 17% year over year. O-Rail, and again, keep in mind the comps on rail from last year, probably a little elevated. We probably had a little overheating. We hadn't seen that kind of growth in intermodal activity in October.
But look, I mean, you can go no further than JB Hunt's earnings.
Yeah.
I mean, they had a stellar earnings. The intermodal was was sort of renaissance. They cut a lot of cost. But JB Hunt told us, if you looked into the earnings call, that their intermodal business is doing well. They're bullish on the direction of intermodal. We obviously have a big rail merger that NS this morning between UP and NS, and the intermodal business has picked up a lot of share.
Yeah.
And this is what truckers are feeling right now. This is what brokers are feeling, is a deterioration in the volume available to them. Because intermodal, the IMCs benefit from that, but most brokers don't have big IMCs. If they do, it's usually a big, like an intermodal, it's either big or small. Like there's very little sort of mid-size IMCs. But what you see in the truckload brokerage market is that yellow line is their core business.
You know, I was talking to Henry Byers, and we were talking about the Los Angeles, Southern California. So the intermodal sector, of course, that's kind of like very omnipresent in the Southern California markets because the import chart leads to the ports. The ports, of course, the quickest way to get it off the boat, just transload it straight onto a train and move it across the country or inland. And we saw a ton of that activity this year. And the Southern California market, from a truckload perspective, had been extremely erratic this year. Like, it's almost like carriers were expecting a bunch of freight at times, and then there wasn't freight, and then they left, and it's
I think
up and down market. What's your
possibly, but I actually think there's something more fundamental. I think a lot of the administration's policies, if you look at Southern California, a large percent of the carriers that operate out of that market tend to be in the very populations that the administration is focused on. And let's talk about, you have the immigration story. And the immigration story is really interesting for two reasons. One is you have the immigrants that don't, they're non-domiciled CDLs. We should pack that for a second.
Right.
But then you also have legitimate perhaps they're first generation immigrants, but they're fully documented, have all their papers, have been here for many years, and should not be subject to deportation because they've paid their taxes, they've been law-abiding citizens, are doing it, maybe have been here for decades. They're also scared to drive. And I think what's happening is, particularly in Southern California, there's been a lot of bankruptcies that have happened. Some of them have been caused by this immigration crackdown, but just broadly, there's been a lot of immigration pressure or economic pressure. And I think what's happened in California is there's been a washout of a lot of capacity. So what we're actually probably seeing in the data is not a reflection of carriers sort of going in and out of California.
Right.
And perhaps that is happening. I think a lot of what's happening is that this market instability of washing out a lot of the carrier base is actually showing up in places like Southern California, where the vast majority, and I'm going to say it's probably in the 70 to 80% of carriers that operate out of Southern California are owned by immigrants or are predominantly ran by immigrant populations, just because that's the culture and that is the demographics of Southern California. And so what I think is actually happening is in these areas where you have very large immigrant population centers is where you're going to see the most fluidity in capacity, because those are one. And like I said, I talked to a major carrier not too long ago, 2 weeks ago, when we started to see the spot market was showing a lot of really weird data. And you and I, we'll talk about that in a second.
Yeah.
I contacted them and they said, look, we're seeing some of our legitimate, fully documented drivers are scared to drive due to the fear of deportation. And just to be clear, it's not just deportation. In fact, there was an article this was 2 weeks ago, right after the Chicago crackdown, where ICE entered the city. I think the National Guard was called in or was going to get called in or something. Yeah. And there was a big crackdown in Chicago. That week was the week where things seemed to change in the freight market.
Right.
And this was, not too long ago, a couple weeks ago. And what was changing was that the spot rates in certain markets were starting to melt up. And it was a big difference between, we didn't see it the tender rejection data or the volume data is abysmal, but we saw it in the spot rates, is that there was a sort of melt up in market conditions. And it seemed to be in pockets of cities. It was in the Midwest of Chicago. It was in Southern California. perhaps even Dallas was having a little bit of that as well.
Right, and I think you wrote an article about
I did.
Serbian Times lawyer.
Well, this was a fascinating article that Adam Wingfield actually shared with me, was that the Serbian Times covers trucking really well because it's the largest Serbian population. And in one of the conversations, or this interview that this lawyer, who's an immigration attorney, actually recommended that drivers, regardless of their status and whether they were legal or not, to actually get off the road. And what he said was that his recommendation is to get off the road because you can't predict how long you would be detained even if you had all your paperwork. And he's like, look, the risk isn't you get deported. The risk is because of the backlog of immigration, these cases, they're not giving bail to people.
Right.
Because under the Constitution, I'm assuming it's the Constitution, once you get arrested and you get out on bail, they cannot rearrest you. So let's say you're an immigrant and the old, under the Biden administration, they would have effectively release you, and then eventually your hearing would come up, a year or 2 years later, and you would get a hearing with a judge, and then they would decide whether you could stay or not go. The risk right now is that you actually get detained and you're effectively put into a prison for perhaps years. And because the backlog of cases is so substantial, that he's like, look, these are miserable places because they're popping up so they're like short-term detention centers that they simply don't have the capacity. It's like, you don't want to be in one of these. And so that message, I think, is starting to show up in these immigrant populations, like the Eastern European drivers that make up Chicago, like the ones in Dallas that are made up of the African populations. And I think what we're seeing is, in Southern California, it's the Latinos. I think it's starting to show up in a lot of the sort of capacity issues in the market.
Yeah, I think it's fascinating that, it's like you said, we're talking about the demand situation. It's not that active. It's not that interesting.
No, demand is absolutely abysmal.
Yeah.
Truckload demand is absolutely abysmal. I think the chart right before, is it 19%, 17%, something like that?
17% down year over year.
Year over year. That's 17% volume. And here's the crazy part. It's not just our data.
Yeah.
Go look at Cass.
Yeah.
Cass, even though we have a partnership with Cass, the Cass Index does their own independent assessment of the freight market. It is at, I think a decade low. You go look at public earnings, UPS, FedEx, truckload carriers, everyone is seeing the softness. I think most of the people in this room are seeing it.
Right.
But the data says that the volume is absolutely, utterly abysmal, but something is interesting has happened in tender rejections. Let's talk about it.
Yeah, we normally don't see, traditionally, especially with the tender data, we always have a pretty strong correlation between demand side indicators and, spot rates and tender rejection rates kind of moving in the same direction. That has not been the case. And this is a fascinating thing. We've never seen this in the data. And what you're looking at here is a national truckload index, line haul only. So we remove the total estimated cost of fuel, makes it easier to look at over time because fuel is very volatile. And really the story of this chart, though, is in the last couple of months, we just talked about how abysmal demand is. These spot rates should not be climbing higher. And yet, here we are moving higher. And then, of course, I added the SAMA there.
I'm glad you did, because let's talk about what SAMA is a forecast. It's a rolling moving average forecast that's adjusted for seasonality. Every chart inside of SONAR has it. It is a way of understanding the data. But Zach, when I look at that chart, that dotted line on the spot rates, which is the NTI index, line haul, so it takes out diesel fuel. That can't be right. It's dropping. Why is that interesting? Because at first you look at that and you're like, well, that's not giving me an accurate number. But it's actually telling you something that may be more profound than even the forecast.
So for those of you that are familiar with me, I'm a data nerd, and I probably drove our back-end team a little wild one Friday, really digging into what was happening with our SAMA, which is a very, basic moving average that's tweaked to the current trend. And we see these movements in a lot of our data this year.
These charts just have these sharp corrections, if you will.
And I had this moment, this light bulb moment where I was like, oh my God, this is actually, that line movement right there, that sharp movement is actually the answer to so many questions that I get about how seasonal is this market compared to the previous one?
Because the big counter argument that I get a lot of times on X when I post something is someone says it happens this way every October. Of course, spot rates are up. But what is so interesting about this is look at that dotted line. And I think this is the most exciting thing that Will has released all year, and you discovered, is that it's telling us that spot rates are actually above the seasonal norm. And in fact, if you follow the seasonality of where spot rates have been, we have broken out of our pattern.
Yeah.
And the reason I think that is so profound is the chart and the data is telling us that the correction of capacity, because we know it's not a volume problem.
Right.
You agree with that, right?
Yeah.
A volume's abysmal. The big question that we've been suffering from for 3.5 years is why are these people still in business and how are they surviving? And what the chart is telling us is that something is changed.
Yeah, something's weird. If you want to think, non-mathematical people out there, think of that dotted line when it does that sharp move as the weirdness line. How weird is
if it looks normal, if that chart goes up in a normal fashion, you can assume that things are operating in a normal season pattern. But if it goes up or down and you have sharp changes, then you know. And I think what's most interesting about that chart right there is that it does reinforce the conversation that the market really in September, after that Labor Day sort of hit, and most recently in October, spot rates are starting to reflect a tighter market. And we have abysmal volume.
Right.
We know this is a supply and demand thing. And the reason I'm so excited is because the riffraff that's been keeping rates in low is starting to churn out of the market.
Right.
And that is an exciting development for anyone who cares about the direction of freight rates, is that freight rates look like they're inevitably going to go up. And it looks like capacity has been leaving the industry at a much faster pace than I think we realized. You're pulling up the tender rejecting data right now. And this is also telling us something.
It's the same basic story. I think most people kind of relate to rates. And the reason I had NTIL up first is because we saw it in the spot rates short term quicker, especially related to the immigration stuff, because that market is more vulnerable.
Well, I think you also are eliminating the bottom of the market.
That's
one
exactly
thing to keep in mind is that when this first immigration thing started to happen about a year ago on X, my first assumption was that it was just pure xenophobia. Like I was getting people like, why aren't you talking about the immigration issue? And I sort of dismissed it as sort of a typical thing you would expect on X. X is a cesspool, by the way. I'm apparently in the middle of that cesspool and a part of that cesspool, but it is a cesspool of a bunch of comments. You should also get on it. But one of the things that I assumed initially was that this was an exaggerated problem. And we started digging into it. Overdrive, who's a competitor of FreightWaves, actually did a really good job on these freedom of information, this FOIA data, and actually determined that a lot of the states, which I found astounding, were issuing CDLs to people who didn't have work permits and had never passed a US CDL test. And the administration called on to this, I think, frankly, through the efforts of X, because they do pay attention. It's funny, we can tweet something, I mean, we being X people that are on Freight can tweet something, and it will show up in the in Sean Duffy's comments that evening, directly, like almost directly quoted. And I just find that incredibly fascinating that the administration is so in tune with the conversation that they will make policy decisions based on the feedback of what's happening on Twitter, right? And so it's really astounding.
You're convincing me to get on Twitter right now and make some
join the cesspool. But what I think is really interesting about this is that when we put pressure on those operators, because one of the questions that we've been asking, Zach, you and I have been asking for years, and has been asked by a lot of people, is how do these guys stay in business? Morgan Stanley did a study, after he's done studies, it says every mile that I think Morgan Stanley had this study, or maybe it's JP Morgan, every mile that a trucker operates is actually at a loss. And I'd heard this from the TCA, is the top 10% performers were above 100 OR. Somebody reported that, told me that, which means they're actually losing money.
Right.
How are they staying in business? And what I think we're learning is with these 200,000 non-domiciled CDLs, and I've got tons of stories that came from my own research, is that those drivers do not care about the consequences of breaking the hours of service rules. They will drive the strong Sergey Solo thing, the meme that gets posted a lot. these guys will run 18, 20-hour days when a legit driver should only get 11 or just only allowed 11. They're running 20 hours a day. So they're able to run at operating costs below the market, which means you have someone that's bottom feeding all the freight. They're able to make a profit because they're willing to break the rules, because the consequences are I get caught. So what? Like I have nothing to lose, right? And I think what we're seeing is that the administration's very strong, and some could say egregiously aggressive, depends on your perspective, but very strong stance against these sort of immigration issues are so forceful that it's intimidating to any of those operators. And you're seeing drivers that would normally drive and not care about that are either driving and staying in full compliance or not driving at all. And I think what's happening is that bottom of the market, and it's the reason tender rejections are slowly moving, but they're not moving dramatically. That bottom of the market is starting to find a base and melt up, because it's telling us that the spot market is losing a lot of that real 100%. Unconventional capacity.
100%. I think this chart tells the story better of what you're trying to illustrate, because the spot rate itself, it's the transactional market. It's in the orange line, and you can see its trend line. If you look at May-ish of 2023, the spot market has been losing capacity gradually for the last couple of years, and this is your low-cost provider. It's the most negotiated rate. This is the brokers who are out there finding the backhauls and matching the freight to the shippers, and there's a lot more flexibility there. So the rate is the most well-negotiated, especially in a down market like we have today. But if you look at the contract rate, that's your larger carrier, larger shipper, 12-month relationship. That hasn't moved.
It's flat.
Yeah.
It's flat, but it tells you that there isn't a ton of downward pressure on rates. We found a base. It's been fairly flat. A little bit of volatility, but not much. But I think what's happening is the spot market is starting to compress, and the data is signaling that there is, particularly the spot rate data, is signaling that conditions are changing.
Right.
And one of the things that I think is pretty fascinating about this is, if you go back to where we were last year, fourth quarter, I made a really early call, a wrong call, rest in peace, freight recession. But not a great call, not my greatest call.
You had some unforeseen headwinds.
Yeah, administration changed policy really
I don't think anybody called 2025 exactly right. Hands in the air. Who called this year? No.
The good news is we can't see the audience. So
I know we can't see. I couldn't tell anyway.
Anyways. What I think is really interesting about that is that I expected when we would see the market turn, it would be sudden.
Yeah.
And what we're actually seeing is a very gradual build. And it's almost like, it feels like an engine.
Yeah.
It sort of sputters, when we actually had internal combustion engines, right? You turn it on and it's like, and it starts and it won't start. And you're like, man, just the old carburetor.
Right.
You ever try to fire up a carbureting vehicle? It's hard.
Yeah.
Either it's too cold or too hot. Those things are finicky. It feels like that. Mm-hmm. And it feels like what's happening is that the market is starting to communicate to us that there is a changing of the guard. And here's where we should get all excited. If we get some economic impulse, some increase in volume, and I say excited depending on your perspective, because if you're a shipper, you shouldn't be excited with this at all.
No, this is bad.
But if you're a carrier, and I got diesel in my blood. Mm-hmm. I'm always going to root for the carriers. I love you shippers. We hope you do really well. But ultimately, I still think that the blood of this industry is through the carriers. I want the carriers to be successful, particularly as abysmal as they deserve a change of guard. And I think it's starting to happen.
I mean, the spot data,
it isn't there yet.
It's not quite there. But I think, the risk here, you see a market that is increasingly vulnerable. It's been 3 years where it has been, look at the spread. Arguably, I would actually argue the contract rates should be going lower.
Because normally they would, but I think, do you have rates on here?
Yeah.
Pull up my favorite chart.
I'll pull up your favorite chart.
This is my favorite chart. And because I can't see, it's 57 cents.
Yeah.
So in a normal market, the delta between, this measures the spot. So in green, it shows that spot rates are higher than contract.
Yeah.
In a normal stable market, contract rates should be higher than spot. So our brokerage margin largely lives in that world. And so during COVID, we had spot rates inflected above contract, and effectively spot rates are always pulling on the direction of rates. Right now, we're at 57 cents a mile cheaper. Contract is there. To your point, contract rates should be trending.
Right.
The reason they're not trending down is that the operating cost of motor carriers does not allow them to lower those contract rates. And so Heartland, who's had an abysmal set of quarters for the last 2 years, used to be, 10 years ago, even maybe 5 years ago, certainly 10. It was the most consistent operator for years. It was the envy of every trucking executive. I want to operate like Heartland because they put up such consistent numbers. That has gone off. One theory I heard, a friend of mine told me who knows the operation very well, that the reason he thinks that Heartland struggled so much is that it refuses to do business with brokers. And because where all the volume has been lying is in the brokerage community, is they can't keep their trucks loaded long enough and run enough miles because they're not doing business with brokerage freight. And I think what's happening is that the larger asset carriers in contract are willing to take freight in the spot market to move trucks.
Right.
But they're not willing to give a shipper a significant discount because they don't want to lock in rates that they lose money in. And I think that's what's happening in contracts. So I don't think there's any risk of contract rates going down, particularly now. I think the big risk is for shippers is that if we get, and I want to say an if because I'm not making big predictions, but if we get a volume surge, and I think economists that track this stuff will tell you that there's a lot of reason to be bullish next year. You have tax cuts that are going to come in. People are going to start to see it in their 2026. Tax refunds are going to be larger. It's going to create stimulus. Housing market, I talked to a firm, the CEO of Housing Wire, which does what FreightWaves does in the housing market, said that the low of the market was actually 18 months ago or last year. It's coming back. You're seeing mortgage applications. The auto market is starting to improve. GM had their earnings. They had a handy beat. 3M. And so these earnings reports and these forecasts, FedEx put up a forecast, are starting to suggest that the economy might be recovering. It's abysmal right now in freight. But if we start to see a pull through in the economy, Fed's going to lower interest rates. The tariffs have not caused massive hyperinflation. But if we start to see it come back, then those surges may be so damaging to the capacity math that we do have a 2020 style rally in rate.
What you're saying now, the economics have largely been unpredictable. A lot of that is uncertainty. That's been the story of 2025, economically speaking. So demand side predictions are, throwing darts at the board. But I think what you're saying, what we're talking about clearly is this market, if there is some sort of catalyst or some sort of demand side recovery in any sense, is probably arguably one of the most vulnerable to a flop because the tender rejection rate chart, I think, does it best here. In the last 3 years, tender rejections do a much better job of explaining incremental changes in capacity in the market because a 3 to 4% jump that we saw from 2023 to 2024, nobody's really going to notice that if you're in the operation and you're in the real world, unless you're looking at the data. The jump from 4 to 6% this year that we've had, again, not enough to make a tangible experience different from a lot of participation perspectives. But what we're seeing, you see these jagged spikes. Last year when you made your call, Craig, in November 8th, I believe it was, because I remember that.
Right, it was right after the election.
It was, the data actually supported you into Christmas. And you see that we started the year off in January.
It was February when things started doing. I think a lot of that was a lot of the noise around, Canada and Mexico, 51st state stuff. It was a lot of the Liberation Day tariffs. I think the noise was so substantial that a lot of companies pulled back on big CapEx. They just went to the sidelines. There was every economist that felt like in America was talking about hyperinflation due to tariffs. Those things didn't happen. Prices in certain categories have gone up, but energy prices are low. Food prices have certainly seen in certain categories, but that's not related to tariffs. We don't import a lot of our food. There's been a couple of coffee. Okay, sure, I'll give you that. But the reality is it hadn't set up hyperinflation. The 10-year or the 10-year has gone down. It's in the low 4s. It's signaling that the Fed's going to continue to cut interest rates. And so there's reason to believe that economic recovery may be coming. I don't know. But what I do know for a fact is that we continue to lose capacity.
Yeah. And that's what this chart is.
And that red is when we lose operating authorities out of the market. That's when they go. And one of the things I think you could be on the cusp of a trucking super cycle. And I'm going to make a statement. If
Ooh, here we go.
if we get a nice volume recovery,
Yeah.
let's think about the reasons that capacity, like what we see in the past years when the market recovers, we have this instant, almost expansionary cycle where big fleets go and expand their trucks, small fleets go and buy a lot of trucks. This time it's different. You have 3 years of almost an industry that's nearly bankrupt. A lot of balance sheets have been obliterated. A lot of companies have been struggling to make money. I think everyone in any recovery is going to feel like, okay, but it's going to turn over again. We are scarred as an industry.
Right.
I'm scarred as an entrepreneur because every month I look at the data and thinking next month might get worse.
Right.
And so I think that scarring is going to prevent banks and entrepreneurs and fleet executives from expansion. Plus, you get the 25% tariff on heavy duty trucks, makes them that much more expensive. So I think what's going to happen in this recovery is it's going to be slow in terms of capacity leaving, which is happening right now. I think we will look back and say the recovery actually started sometime in mid-year 25, maybe over the summer when we started to see those changes. And we will look back and say it was slow to start with and there was some inflection point. And even at that point, I think carriers are going to be reluctant to add capacity because they're going to be like, well, this is short-lived.
Yeah.
We've lived through these real fast cycles and we're not willing to do it again. And then you've got an employment problem is you're not going to have truck drivers because you've taken out it. I think the BLS data, the Bureau of Labor Statistics, said 18% of truck drivers, and this is 2021.
Yeah, 21 days.
Was immigrants, and we know that the number of immigrants, just the data has exploded since then. And trucking is a very attractive job for immigrants, especially if you can drive it without a work permit. I think that number is probably. Yeah. An insurance executive told me he thought the number was around 40% of first-born immigrants. And so that number is going to be pretty substantial. And I think that's going to take a lot of that capacity and that recovery. I don't think the administration is going to change their policy on immigration. They seem like their whole policy on tariffs do flip-flop a lot. There's no tendencies I see in them softening their immigration stance.
They're still recruiting for ICE.
Yeah, and so I think as long as that exists, ICE has a $30 billion budget. That's as big as most militaries. It would be I think it's top 10 military if it was a military.
Well, we were going to take some questions. We got a few minutes.
I don't know if I can see.
I don't even know if I can see.
Do we have a mic? I can't. It's very hard to see. So you guys are welcome to ask questions. We'll take a few minutes.
Yeah.
When
we have people that'll run around and hand you a mic.
Zach, you have any big predictions for this?
I don't know. I'm not the hyperbolic one here.
You avoid making predictions so you can't be wrong. I don't know what he was saying.
Oh,
yes,
let's go.
Hey guys, can you talk a little bit more about the difference between maybe van market versus temp control market with some of these trends?
Oh yeah, I didn't even bring out the breakdown here, but the temp controlled market, much more responsive, much more volatile too. So it's been a break from seasonality that we traditionally saw pre-pandemic. We've had these like huge swings in refrigerated market moves. Like we now have this like fall and winter season for refrigerated that we didn't really have it wasn't as robust back in the day. And then we're coming in, like spring has become like the off season as the temperature warms up and protect from freeze goes out of style for a couple of months. And then we haven't had a strong produce season coming out of California lately. So the refrigerated market is kind of having inverse seasonality right now. And on top of that, but it's not necessarily more stable because we see these huge swings now when we do have spikes. So again, refrigerated capacity is roughly 20% of the market. It's a third.
It also didn't have the big expansion area. I mean, refrigerators, they're expensive, right? Yeah. Like, so drivers, particularly the sort of bottom feeder drivers, tend to go out and buy the van trucks.
Right.
You see the same thing in flatbed, is that flatbed has its own massive volatility because it's a much tighter market.
Well, flatbed has actually gone into a bit of a lull here after the spring.
Well, a
it
lot
was
of it's
having a
because
moment. The tariffs hit, and
construction sucks.
and
Housing starts to suck. And
the sector it serves.
until you see a recovery in housing, you're not going to see a stronger construction market.
Right.
And like a lot of this is getting, there's just so much inventory of houses on the market right now that are not moving, that I think in order, you need to move that stuff out before builders will have confidence to build.
Yeah.
I think is one thing.
Right.
All right, we have one more. Yes, sir. They're coming. We're sorry. It's a.
The lights.
The lights are kind of hard for us to see what's going on.
Can you guys touch base more on the flatbed market, specifically how it relates to, because we all know, drivers, specifically undocumented drivers, or, the immigrant drivers, usually tend to go more for the dry van sector,
Right.
the refrigerated sector. Can you touch base a little bit about how that affects the flatbed market or flatbed capacity in general?
The data would suggest that it really doesn't impact it as much.
I disagree with you.
Yeah.
And
Okay.
my statement would be that while it may not historically has done it, when you remove hundreds of thousands of truck drivers from the market, wages for every carrier go up. And the larger carriers, JB Hunt said this yesterday, for those that were in the room, is they're not adding big bonuses to hire drivers. They're not paying $10,000 sign-on bonuses like they did 5 years ago. What will happen is if we see a melt up in rates and we start to see the larger carriers start to feel pain around truck drivers, then they will spend almost anything they can to get those drivers, and that will make it more attractive for people to leave the flatbed business, which doesn't have a lot of large carriers, into the over the road.
Well, yeah, long term for sure.
And that labor
Impacts all of
situation.
them.
I mean, look, we saw Montgomery.
Yeah.
That went out of business, the number 3 flatbed operator. That will have a profound impact. But I think the story for all of this is the driver. Like, drivers have always been the capacity constraints. Buying a truck, I get asked this a lot. Well, you have to have a truck. I said, yes, but what will happen is these trucks, typically what happens with trucks when they get used and are older and say 7, 8 years is they enter in the export market. We export them to Mexico, Russia. That hasn't been happening because a lot of the lower end carriers have been buying up those older trucks and putting their drivers in it. Because the drivers that come over from overseas, particularly the ones that are non-documented, are willing to drive in anything. Like, it's hard to find an American truck driver that will drive willingly in a radial rig. But if the dude is over here for 90 days on a temporary guest visa, which there's a lot of stories about that, or here undocumented, he doesn't care what he's in.
Right.
And there's stories of 3 drivers in a truck that live in a truck. And these are stories that I've heard from people who have seen the industry. And so I think what happens though is if we eliminate a lot of the immigrant population that's in the industry, that's going to put pressure on everybody, which is going to be just another capacity constriction. And ultimately, the flatbed industry is the one that wins the biggest because it has the least amount of flexible capacity in the entire market. There aren't a lot of flatbeds.
Does your answer stay the same, even considering the safety aspect for flatbed? Because obviously, in my humble opinion, I believe the undocumented or the immigrant drivers tend to go for the van and the...
You're absolutely right. The data suggests everything you said.
Right.
Because there was no response from this latest thing in the flatbed data specifically. We saw it in refrigerated and dry van the most. So probably, and I'm certainly, I don't think we were disagreeing. I think
the flatbed market, the problem with the flatbed market, until you have a housing market, you're not gonna have a flatbed market. Like that, like at the end of the day, and you can see this in our data, is you can take housing starts, which the nice thing about SONAR is you can actually compare some of this macro data.
Yeah.
It's single family housing starts has a very direct correlation with flatbed demand. It just does. And it's the summer season, right? It's 90 days of summer, I think Bo King likes to say. That season is the season where you have massive amounts of flatbed demand. When that season does not exist, did not happen, which is what happened this year, it's just no volatility in that market because it's flat.
Yeah.
But if we lose truck drivers from the core van business, which will happen, the immigrant population, that freight will get picked up. The larger asset carriers, and I'm talking about the megas, the Schneiders, the Werners, the CR Englands, the US Express, Swifts, whatever, those guys will pay anything to get drivers. They're not doing it right now because they don't have to work. Like they can hire people or outsource their operations to get them pretty cheaply. And and Spencer Frazier said this yesterday for those that were in the room from JB Hunt, we don't have a driver shortage, which I loved him saying that, but a mega carrier that agrees with me there is no driver shortage. He says we have a pay shortage. And he pointed out until we start seeing $10,000 sign-on bonuses by the largest carriers, you're not, and that's what will happen. These drivers that are in the flatbed market will leave to go take advantage of drive for Schneider for $10,000. They'll get their bonus, drive for 6 months, and they'll come back where the higher pay is, especially in the off season. And I think once we eliminate the driver population that has created the excesses in this industry, that's when things will change. And that's coming, if not already happening.
All right.
We're getting booed off stage,
Yeah.
or
It's lunchtime.
the lights are off stage. So, thank you, Kaylee. Thank you guys.